In this video, I'm talking about investment trends, and because property is such a hot topic at the moment, that's what I'm going to focus on for the most of this video. Now, everything's going to be covered under general advice and factual information. Financial markets and investors tend to be forward-looking, and financial markets also have this capacity to overvalue assets and undervalue them for long periods of time. Now, when we look at the Australian property market, we've seen that it's overvalued. It has been that way for a long period, and it's a really big question of whether it's a huge property bubble that's going to burst or not. Now, this video is really not making monstrous predictions about huge property corrections, but we're just going to talk about trends and some of the opportunities around them. Because markets and investors tend to be forward-looking, they also tend to price in future events that they know have a really high level of certainty around them. And likewise, they tend to discount things where it's not very certain, to give you the opposite sort of viewpoint. So as you can see here, there's an uptrend. The market's looking forward and pricing in some future event. In contrast, here's the opposite. In a downswing, we've got a downtrend, same thing happens, it just happens in reverse, that's all. Here's the S&P 500. You can see down the bottom we have the dates, and we can also sort of see that markets are always pricing in those future earnings and events that are happening at the moment. So a good guide is the markets are normally looking about 2 years out in advance, because that's where they have a really good level of certainty. In contrast, if something happens that the market has not priced in, you can get some pretty rapid price movements. Now, normally when expectations and reality are normally different. When it comes to house prices, things tend to be a little bit different as well. Here's the Sydney House Price Index, and you can see that this is a daily chart. This is pretty close to the top of the market, and it's really only been downhill from there. Now, when you look at the 12-month figures year on year and you sort of compare them, you can also have a look at this particular table. All of this is available on the CoreLogic website. With that said, here's the ABS data from 2003. They changed their methodology back then. And as you can sort of see, we really had kind of like a coiled spring, so to speak, post-GFC, sideways house price movements. Now, this doesn't factor in inflation, and I think that's really important as well. It also doesn't include the last quarter of 2018, which once again we've seen prices decline 10% over the last 12 months. That would need to be added in as well. Now, when it comes to my personal opinion, I think a lot of political risk is not being priced in at the moment. There's definitely a lot of people who are concerned, sitting on the sidelines, and I'm really talking about the rules and the changes around negative gearing, capital gains tax, the franking credits, and superannuation. Now, these are all Labor policies so far, and it's got quite a lot of people worried on the sidelines. Now, this is something that I'm going to unpack in future videos. Oh wow, where do I even begin with the regulatory risk? I work in financial services. I spent 2 years as a financial advisor, had a no commission offering, so it was 100% fee for service and a rebated all hidden fees. Now, a lot of the things that have come out of the mortgage broking industry from the Royal Commission have really been around the lending standards and how expenses haven't been categorised correctly, and really haven't been assessed when people are looking at serviceability. So overall, this has impacted the credit supply. The banks have cut back on their lending, and as a result, it just means that people borrow less, and prices have fallen as a result. Now, I think there's plenty more still to come on this issue, because now the banks have tightened up their compliance processes when it comes to mortgages, and there are plenty of stories where people have now got to verify exactly where their money's going during a loan application. And I mean, for the sums that we're talking, realistically, you should have to substantiate where your money's going if you're applying for a $500,000 loan, for example. Like, the idea that people just didn't, it's kind of backwards thinking. So with the uncertainty, we've seen the downswing, we've seen the change in credit supply. That's definitely put a dampener on prices. But when you actually look at the buying process, the underbidder drives the actual price in either an auction or in a private treaty. because typically people just run out of money to borrow and then they hit their spending capacity when we're talking about property price. So the question for me is, what's the maximum amount that the underbidder can spend? That's really going to set the property price. So when the person who's got the most amount of money to spend, once they get taken out of the process, either by buying a property or through availability of credit, what happens is the property price would just fall because there's no one to bid that price up any further. Now, I want to reorganize this data and put it in comparison. Now, pre-Royal Commission, people were able to borrow more and there were less questions asked. Post-Royal Commission, it's highly likely that people will have to substantiate how much money, and they're just not going to be able to borrow as much, or there's going to be less people that can do that. Now, if we organise this and just sort of say the availability of credit and the amount of money people can spend is less, well, you just get a gradual decline in property prices. Now, this excludes anything like mortgage stress or anything like that. Now, if I had to put my finger on the pulse, pre-Royal Commission and 2018, we've seen a 10% decline in property prices. That's all been confirmed. It's all in the past. The next big challenge is going to be what comes out of the Royal Commission, whether there's going to be any wholesale changes there, or what political risk is actually going to have an impact on the marketplace. Now, at this stage, I don't think some of those things are priced in. And we also haven't really considered what may happen with some of the behavior that investors and just households display. To give you an example, here's just a set of property prices as if someone was paying down a loan. You can see the total equity goes up from 2016 to 17, but then if property prices were to fall, 2018, 19, 20, you can see that, they've lost a significant sum of money in that. Now, I think that because markets don't like the uncertainty, there's also loss aversion. When we look at what lies ahead, there's some economic headwinds around the trade war. There's some political uncertainty here with the Labor Party's policy. There's regulatory risks around the Royal Commission. There's changes in sentiment because of the wealth effect. People may spend less in the future because of either mortgage stress or the expectations around property prices. They might not feel as wealthy, but I definitely think this is an opportunity for people to use things like the First Homeowner Super Saver Scheme and set themselves up for buying their first property if they haven't already done so. I've got plenty of videos on the channel. You can always like, share and subscribe those, and feel free to leave a comment down below.